Testing 1 2 3. Testing 1 2 3. Testing 1 2 3. Testing 1 2 3. Hello, this is Jordan, and this is your precious metals market update. This video is being recorded on the evening of Saturday, January 28th, 2017. And in this video, I'm going to discuss the bearish reversal in gold and what it means for the gold stocks, which have been showing increasing relative strength in recent months. Now in this chart, it's a weekly candlestick chart. We have gold at the top along with its 80 and 160 week moving averages. Those are equivalent to the 20 and 40 month moving averages. And at the bottom we have gold against foreign currencies, which more precisely it's gold against the inverse of the US dollar index basket. So I use the ETF UDN for that, and also we include the 80-week moving average. And I want you to focus on the last couple weeks and the yellow circles there. And what we see in gold at the top is gold rallied about $100 an ounce from 11.20 up to 12.20. Now, 2 weeks ago, gold finished the week higher, but it closed below the 80-week and the 160-week moving average. And this past week, gold opened up at 12.09, went up to 12.20, and then you had a full-blown reversal down to 11.88. And if you look at that candle, it engulfed the previous candle. And what also makes it bearish, as you can see, that candle occurred at a confluence of major resistance. I mean, 12.20 was a target we had for this rally. Before this reversal, we were looking at the potential that gold could rally up to 12.50. But as you see there, the reversal occurred at lateral resistance and moving average resistance. And I think that 12.20 is also around the 38% retracement of the decline. So on the weekly chart, it's just right now it looks very bearish for gold. I'd be really surprised in the next couple weeks if gold was able to get above 12.20. And this isn't just a US dollar phenomenon. I mean, the reversal was even worse if you're looking at gold against foreign currencies. And it was also right around lateral resistance on that chart. And that reversal, if it is maintained over the next couple weeks, then it looks like gold against foreign currencies could lose its 80-week moving average. And so ultimately, you can see the trend line there at the bottom, which is intersected at about 52 on the chart, which is about 10% below Friday's close. So that's a potential downside target for gold against foreign currencies. Still in a long-term uptrend that began at the very end of 2013, but it looks like it could come back another 10%. That's a downside risk. And after this past week in gold, the risk of gold retesting 1050 in the next couple of months has definitely increased. I mean, it doesn't mean gold is going to drop down immediately, but it looks like the rebound that we had is probably over. I mean, it's possible that gold could go down a little bit, then rally back up and try to get through 12.20 again. And if it failed again at that point, then that would be very bearish. But right now, looking at gold and gold against foreign currencies, it definitely looks bearish over the short term and medium term. Now here we're going to talk about the gold stocks for the rest of this video, and this is a weekly line chart. So every weekly close is a point on these charts, and we have GDXJ at the top, GDX in the middle, gold at the bottom, and clearly we can see the divergence here in the last couple months. I mean, look at GDXJ and GDX. They're trading well above their 80-week moving averages, whereas gold, as we already noted, it failed at its 80-week moving average. In fact, something I pointed out a couple days ago, GDXJ was actually trading, I think, 23% above or 26% above its 400-day moving average, which is equivalent to the 80-week. and gold was trading below it. So the last couple months we were seeing some real, some real relative strength in the miners. And just to piggyback on that, it's really evident on the monthly charts, and the month is going to end in a couple days. So for all you chartists out there, start getting your monthly charts ready. I mean, at the end of the week, you should look at weekly charts. End of the month, look at monthly charts. But anyway, that divergence is clear here, and I'm using GDXJ, but we see the same thing in GDX, but I invest and speculate in the juniors and not the larger companies. But anyway, so we have GDXJ there, gold at the bottom, 20-month moving average for both. And look at gold. I mean, it went below. Look at the last three candles. In November, the third to last candle, it went below and closed below its 20-month moving average. Then in December, it remained below it. This month, January, it tested it, traded above it, but in the moving averages is at 11.99. So we'll see if gold can manage to close at 1,200 or higher. I don't know if it's going to do it. I mean, the way it's looking right now, this is the third consecutive month gold has been below, or has closed below its 20-month moving average. Whereas with GDXJ, November it was down, but it closed above it. December it traded below it, but closed well above it, because you can see the bullish hammer there, and that's been validated by right now the 17% gain in GDXJ from this month. So there's a clear divergence here where gold is basically failing at this moving average in the last couple months, and GDXJ is holding. I mean, it hasn't gone below it since it closed above it in February of last year. And this is just a chart here that reaffirms the strength that we've been seeing in the gold stocks. It's the GDX advanced decline line. I'd like to try and find a source for the AD line in GDXJ. But anyway, the advanced decline line, I mean, this is really the holy grail of leading indicators. It's one of the best breadth indicators. And we can see here that the advanced decline line for GDX is showing a positive divergence. It's made a higher high relative to its secondary peaks in October and November. And if you look at GDX, it's still below those peaks in October and November, which were right around 25. In fact, the advanced decline line at that peak that it made, I think a week or so ago, that peak is close to a 4-month high. It's at least at a 3.5-month high. And if you go to that equivalent point back, I think it's around the end of September, and you find that equivalent point for GDX, it's at 27. So the advanced decline line is, that's not to say that GDX should be trading at 27, but it just shows us again that we're seeing leadership from the miners, and we're seeing strong participation from the sector. And that's what you want to see. I mean, that's what you see in a bull market. This would be a much bigger concern if the advanced decline line was much weaker. And last point on this, the advanced decline line, it only retraced 38% of that huge move last year. I mean, look where it bottomed. It didn't even come close to the 400-day moving average, whereas GDX went below its 400-day moving average and ended up retracing about 62%. And if you look at the advanced decline line, I mean, I didn't show you here, but I looked at it myself. It retraced 38%. I mean, retracements can be 38%, 50%, 62%. So that's just another indication of the strength in the advanced decline line. And, getting towards the end of this video, I mean, the question is, gold looks bearish. The miners are showing relative strength. So what's going to happen with the miners? Well, has this rally peaked yet? I mean, it's possible that the miners could make one more little push higher. We have GDXJ at the top. We have my junior index at the bottom. And both are approaching, I mean, they could go up 6 or 7%. I think that's the potential upside here, but they are, I mean, approaching a confluence of very strong resistance. I mean, very strong lateral resistance, and that includes the 200-day moving average, and for both charts. And so that's the 200-day moving average is very close to that the red lines in both charts. I think this rebound that we've seen in the minors, like I said, it may have one more push higher, but this is not a point where you want to be full on buying things. I mean, there probably are some things out there that have really good value right now. In fact, I've discussed a few things in the nano cap world. I mean, those are extremely risky things that we only invest 2 to 3% of the portfolio in, but things that have 5 to 10 times potential. But those are the kind. I mean, those are the only situations right now where I see the real value. I mean, there was value in a lot of things a month ago, as you can see in these indices. I mean, now they're up 35-40% from those lows. And if we see gold, if indeed this bearish reversal holds and gold comes down, retests 1050, or goes to 1,000 and makes that bottom that I've been calling for, others have been calling for, then I think the miners are probably going to sell off. But perhaps they end up retesting their recent low, which is right around the 400-day moving averages, and bouncing from there again. Because if you look at GDXJ, it's near 37, and that low is around 27.5. So I mean, that's a pretty good decline. 10 points off of 37. I think that's about 30%, or maybe a little bit more. So I bottom line here is I think this rally is nearly over. Might have a little bit more to go, and you probably want to, if you're looking to buy, you should probably wait for a couple months and see what happens to gold. When we see gold break down, I mean, if that happens, if we see gold break down, get below 1100, get below 1080, that's going to be the time you want to get into the minors, get into the juniors again. That's all for this video. You can follow all of my work at thedailygold.com. You can opt in for my free newsletter there. You get a weekly update every Sunday. It includes my most recent thoughts on the sector and some snippets from my premium update from the day before. Thanks again for listening and watching, and I look forward to publishing another video update for you in the days and weeks ahead.